Panic of 1792. The Panic of 1792 was the first financial crisis in the United States, triggered by speculation in government debt and leading to a stock market crash and bank failures. Panic of 1819. The Panic of 1819 was the first major financial crisis in the United States, caused by land speculation, excessive borrowing, and a contraction of credit, resulting in bankruptcies and economic depression. Panic of 1837. The Panic of 1837 was a financial crisis in the United States, characterized by a speculative bubble in land and railroad investments, followed by a severe economic downturn and bank failures. Panic of 1857. The Panic of 1857 was a financial crisis in the United States, caused by overexpansion of the railroad industry, speculation in land and commodities, and a collapse in confidence, leading to a severe recession. Panic of 1873. The Panic of 1873 was a financial crisis in the United States, triggered by the failure of a major bank and a subsequent stock market crash, leading to a prolonged economic depression known as the Long Depression. Panic of 1893. The Panic of 1893 was a financial crisis in the United States, sparked by the collapse of railroad overbuilding and a run on gold reserves, resulting in bank failures, business bankruptcies, and widespread unemployment. Panic of 1907. The Panic of 1907 was a financial crisis in the United States, caused by a stock market crash and fears of a banking collapse, leading to a liquidity crisis and prompting the creation of the Federal Reserve System. Great Depression, 1929-1939. The Great Depression was a severe worldwide economic depression that began with the stock market crash of 1929, characterized by bank failures, unemployment, deflation, and widespread poverty. Savings and Loan Crisis, 1980s. The savings and loan crisis was a financial crisis in the United States, caused by deregulation, risky lending practices, and a collapse in the savings and loan industry, leading to a taxpayer bailout and economic recession. Black Monday, 1987. Black Monday refers to the stock market crash on October 19, 1987, when global stock markets plummeted, triggered by concerns over rising interest rates and computerized trading, though it did not lead to a recession. Asian Financial Crisis, 1997. The Asian financial crisis was a financial crisis that began in Thailand and spread to other Asian countries, caused by currency devaluations, excessive borrowing, and weak financial regulation, leading to economic recession and financial turmoil. Russian Financial Crisis, 1998. The Russian financial crisis was a financial crisis in Russia, triggered by a sharp decline in oil prices, a collapse of the ruble, and a default on government debt, leading to economic collapse and political instability. Dot-com bubble burst, 2000. The dot-com bubble burst was a financial crisis in the United States, characterized by the collapse of internet companies and a stock market crash, caused by excessive speculation and overvaluation of technology stocks. Enron Scandal, 2001. The Enron scandal was a corporate scandal involving accounting fraud and corruption at Enron Corporation, one of the largest energy companies in the United States, leading to its bankruptcy and the collapse of Arthur Andersen, one of the largest accounting firms. Global Financial Crisis, 2007-2008. The global financial crisis was a severe worldwide economic crisis that began with the subprime mortgage crisis in the United States, leading to a banking crisis, stock market crash, and recession, with widespread effects on global financial markets and economies. European Debt Crisis, 2009. The European debt crisis was a sovereign debt crisis in the Eurozone, characterized by high levels of government debt, banking instability, and economic recession, leading to bailouts and austerity measures in several European countries. Flash crash, 2010. The flash crash refers to the sudden and rapid decline in stock prices on May 6, 2010, caused by high-frequency trading algorithms and market volatility, though markets quickly recovered. Greek financial crisis, 2010. The Greek financial crisis began in 2010 when Greece revealed its budget deficit was much higher than previously reported, leading to a sovereign debt crisis, austerity measures, and bailouts from international creditors. China stock market crash, 2015. The China stock market crash of 2015 saw a sudden and steep decline in Chinese stock prices, triggered by concerns over economic slowdown, stock market manipulation, and government intervention. Brexit, 2016. Brexit refers to the United Kingdom's decision to leave the European Union following a referendum in 2016, causing economic uncertainty, currency fluctuations, and trade disruptions. Turkish currency crisis, 2018. The Turkish currency crisis of 2018 saw a sharp depreciation of the Turkish lira, fueled by concerns over political instability, high inflation, and tensions with the United States, leading to economic turmoil and recession. Argentine financial crisis, 2018. The Argentine financial crisis of 2018 stemmed from a currency devaluation, rising inflation, and fiscal deficits, prompting a series of loan agreements with the International Monetary Fund to stabilize the economy. COVID-19 pandemic recession, 2020. The COVID-19 pandemic recession resulted from the global economic downturn caused by the COVID-19 pandemic, characterized by lockdowns, business closures, unemployment, and government stimulus measures to mitigate economic damage. Evergrande crisis, 2021. The Evergrande crisis involves China's Evergrande Group, one of the world's largest real estate developers, facing financial difficulties and default risks on its massive debt, sparking concerns of contagion in global financial markets. Crypto market crash, 2021. The crypto market crash of 2021 saw a sharp decline in cryptocurrency prices, triggered by regulatory crackdowns, environmental concerns over energy usage, and speculative excesses in the market. Inflationary concerns, 2021-2022. Inflationary concerns in 2021 to 2022 revolve around rising consumer prices fueled by supply chain disruptions, pent-up demand, and expansive monetary policies, prompting central banks to consider tightening measures. Russian-Ukraine conflict, 2022. The Russian-Ukraine conflict of 2022 involves military tensions between Russia and Ukraine, raising geopolitical risks, energy supply concerns, and market volatility in global financial markets. Supply chain disruptions, 2022. Supply chain disruptions in 2022 stem from disruptions caused by the COVID-19 pandemic, labor shortages, shipping delays, and logistical challenges, impacting global trade and economic recovery efforts. Housing market bubble, 2022. The housing market bubble of 2022 involves concerns over inflated housing prices, speculative buying, and affordability issues, leading to fears of a potential housing market crash and its broader economic implications. Sovereign debt defaults, 2022. Sovereign debt defaults in 2022 refer to concerns over the ability of certain countries to meet their debt obligations, potentially leading to credit downgrades, financial instability, and market contagion.